Okay, so let's unpack this. Imagine being told your house could probably sell for, I don't know, $500,000,
Hmm.
and then voluntarily choosing to sell it for $430,000 instead, on purpose.
Right. Just leaving that money on the table.
Exactly, just walking away from it. Usually when we talk about real estate, it is all about squeezing every single possible dime out of the property.
Hmm.
But today, we are doing a deep dive into a really bizarre and actually growing demographic of homeowners who are intentionally walking away from the open market.
Yeah.
And the craziest part is the math suggests they might actually be the smart ones.
It is wild when you actually look at the
It
numbers.
really is. So
Yeah.
we're digging into a corporate framework and some really illuminating analysis put together by John Constantine at American House Offer. They are a company operating in Riverside, California, and they execute what they call a 7-day sale. Our mission today is to figure out the mechanics and the motivations behind this phenomenon. Like, why are people completely bypassing traditional real estate agents for these hyper-fast, direct cash buyers?
Well, looking at Constantine's framework, it gives us this incredibly revealing sociological and economic window into modern homeownership.
Yeah.
It really forces us to examine a fundamental tension. We are looking at how people today are calculating the value of their time, right, versus the value of maximum equity.
Which are two very different things.
Exactly. It is a behavioral economics case study just hiding in plain sight. It demonstrates what happens when traditional systems become just too bloated for people who really just need an exit.
Which is exactly why we were diving into it. But to understand why someone needs an exit strategy that fast, we kind of have to look at the specific friction they're trying to escape.
Right? You have to look at the location.
Yeah, Riverside has a very specific housing landscape. You've got these beautiful historic properties in the wood streets, places built in the 1920s and 30s.
Oh, yeah, gorgeous homes.
Beautiful. But
Mhm.
then you also have mid-century builds over in Arlington and, of course, much newer construction out near Canyon Crest.
Right, and that diversity is what makes the area so interesting. But it also it creates massive disparities in property maintenance.
Oh, for sure.
Because if you own an older home in an established district like the Wood Streets, you aren't just dealing with peeling paint or, landscaping.
Right.
You are often harboring significant, totally invisible maintenance issues. We are talking about lath and plaster walls,
Oh, yeah.
knob and tube wiring, cast iron plumbing that is literally rusting out from the inside, or foundation settling. These are massive capital outlays.
And you can't just ignore them.
No, you have to fix these things before a property can even legally or practically be listed on a speculative open market, assuming you want a buyer who needs a traditional mortgage anyway.
Right, because a bank isn't going to fund a house with dangerous wiring. And the people dealing with these specific properties aren't always like young, first-time buyers who want to spend their weekends watching YouTube tutorials on how to tile a bathroom.
No, not at all.
The demographic outlined in this framework is heavily concentrated in the 30 to 65 age range.
Mm-hmm.
So you are looking at mid-career professionals, maybe some investors, or people who are just stepping into retirement.
Right.
They understand the value of their weekends. I mean, the idea of spending 6 months acting as a general contractor to rehabilitate an aging property in, say, the La Sierra neighborhood is just a non-starter for them.
They simply refuse to do it. And what is fascinating here is the ongoing burden of simply doing nothing.
Wait, what do you mean?
Well, if you just let the property sit while you decide what to do, you are bleeding money.
Oh, right.
In Southern California, holding costs are aggressively rising, property taxes are high, insurance premiums have skyrocketed recently, and then you have the localized environmental factors.
Like the heat.
Yes. Think about the intense Inland Empire summers. August rolls around, it is 105 degrees.
Yeah, I see.
You have to keep a vacant or inherited property air conditioned to some degree just so the drywall doesn't crack and the fixtures don't warp.
Wow.
The utility costs alone will actively drain your equity with every passing week.
It sounds like owning an aging house in Riverside is less like having a traditional piggy bank that just gathers value,
Okay.
and more like holding a leaky bucket.
Leaky bucket, yeah, that is a great way to put it.
Like every month, water is just dripping out in the form of taxes, insurance, and electricity bills for a place nobody's even living in.
Exactly.
But, well, wait, hold on. I have to push back here a little bit.
Sure.
Because we are taught from day one that a house is a cornerstone of generational wealth. It is the biggest financial asset most people will ever own in their lives.
Of course.
So walking away from an open market listing just sounds like you are letting yourself get scammed for convenience. Like, why wouldn't you just fix the bucket, fix the house, get a real estate agent, and get top dollar?
That is the pivotal question. And it really comes down to understanding the difference between a capital outlay and a guaranteed return.
Okay, break that in for me.
So the traditional method of fixing the house, finding an agent, and listing it relies entirely on a speculative public market.
Right.
You pour $20,000 or $30,000 into a roof and some modern flooring, just hoping the market rewards you for it.
Yeah.
But that traditional timeline takes 45 to 90 days on average.
That is a long time.
And that is assuming everything goes perfectly, that the buyer's financing doesn't fall through, and the appraisal actually matches your asking price.
Which is never guaranteed.
Never.
Yeah.
For the demographic we are talking about, that preliminary financial risk combined with the massive time investment is a gamble they just cannot afford.
Okay. So they are trading the gamble for certainty.
Exactly.
But if the traditional method is too slow and too speculative, how exactly does this 7-day alternative mechanically function? I mean, moving a piece of real estate in 7 days sounds chaotic.
It sounds like it, yeah. But the mechanics are actually surprisingly straightforward once you remove the traditional gatekeepers.
Okay.
The fundamental difference between a standard buyer on the open market and a direct buyer like American House Offer is the source of the funding.
The money itself.
Right. Standard buyers rely on mortgage approvals. Mortgages mandate rigorous bank appraisals and very strict property condition requirements because banks despise risk.
Of course they do.
If they have to foreclose, they want a pristine asset they can resell easily. But direct buyers utilize private capital. They don't need a bank's permission.
Oh, wow. So that entirely changes the timeline.
Completely.
Because the framework breaks down the data side by side. The traditional real estate agent path takes 45 to 90 days, with a moderate risk of the whole thing falling apart because of financing contingencies.
Right.
Then you have the for sale by owner route, which stretches out to 60 to 120 days, and that has a notoriously high probability of falling through because you are constantly dealing with unqualified buyers.
Yeah, that is a nightmare.
And then the accelerated cash sale, 7 to 14 days. Very low probability of falling through because the cash is already sitting in an account.
A massive part of that speed comes from the as-is evaluation reality.
Okay, what is that?
Well, when these direct buyers assess a home, their experts are looking at the underlying structural value and the market location.
Yep.
They completely ignore aesthetic deficiencies. The homeowner doesn't need to apply fresh paint. They don't need to rip up worn carpets. They don't even need to repair a leaking fixture in the guest bathroom.
Wow.
The offer is generated based strictly on how the house sits today.
See, here's where it gets really interesting, though, because I am looking at the specifics of what they actually accept. And they take properties with severe structural damage, unpermitted additions, and even active building code violations.
Oh, yeah, all of it.
Like, let's say someone in 1985 enclosed a patio without pulling permits from the city of Riverside, and now the city is fining the property. The direct buyer literally takes on the responsibility of dealing with the municipal departments after the title transfers. Plus, they waive appraisal fees, inspection fees, and administrative costs. But, I mean, there has to be a trade-off. They aren't running a charity.
No, definitely not.
If they are eating the risk of unpermitted additions and taking on city code enforcement, the trade-off has to be the initial offer price.
Yes, and this raises an important question about the nature of arbitrage. What this model executes is essentially an arbitrage of convenience.
Let's unpack that term, arbitrage of convenience. You mean they're basically buying your headache at a discount, solving the headache themselves, and pocketing the difference?
That is exactly the mechanism. They are purchasing the asset at a price that deflects the raw structural value minus the anticipated friction of fixing it. By entirely removing external dependencies, they don't need a bank to approve a loan at the 11th hour. They aren't charging a 6% real estate agent commission. They aren't forcing the seller to vacate the house every Sunday for an open house.
Which is a huge pain.
Right. They streamline the path to the title company. The title officers just verify the legal standing, ensure there are no unresolvable liens, and because the private cash is already secured, they close the transaction in days instead of months.
So if they are taking a cut on the price to eat all that risk, who actually accepts that? Like, who needs out of a house so badly that they will trade potential gross profit for ultimate speed and zero friction?
There are a few very common scenarios.
Let's get into the human element of this then. Because the decision to do a 7-day speed run on your biggest asset doesn't happen in a vacuum. The framework identifies some very specific, often sudden life events that drive these sales.
Right. The first major category is resolving inherited estates.
Okay, think about inheriting a house. It sounds like this incredible windfall, right? You get a phone call, and suddenly you own real estate in California.
Sounds great on paper.
But Constantine points out it is usually a logistical nightmare. Imagine you just inherited your aunt's house in Riverside, but you live in Ohio. You have a full-time job. Are you going to fly to California every weekend to manage contractors who are fixing up a house built in 1950?
Probably not.
Probably not. Or maybe it is a local family, but they already own a primary residence. They do not want to take on a secondary mortgage, double property taxes, and the headache of bringing an old house up to modern codes.
And in those estate situations, you also frequently have multiple heirs.
Oh, true.
If 3 siblings inherit one aging house, deciding what to fix, who pays for the materials up front, and what real estate agent to use can tear a family apart.
I can only imagine.
A rapid cash sale lets them liquidate the asset immediately, divide the cash fairly among the heirs, and completely avoid prolonged legal or interpersonal disputes.
That makes a lot of sense.
And that same desire for a fast, clean break applies heavily to the second category, which is divorce settlements.
Right, because in a divorce, the family home is almost always the largest shared asset. If you try to manage a traditional real estate listing, you are forcing 2 people who are in the middle of separating to act as business partners for 3 to 6 months.
Yeah.
They have to agree on repair costs, keep the house pristine for showings, and negotiate with potential buyers together.
The emotional and financial stress of that is immense. Having a lingering joint mortgage ties their credit together and prevents either person from moving on.
Wow, yeah.
A 7-day transaction provides an immediate division of equity so both parties can take their share of the capital and start rebuilding independent lives, without being tethered to a shared liability.
That is huge. And then there's the category of avoiding foreclosure. Economic shifts happen, layoffs happen. When mortgage payments fall behind, the bank doesn't wait forever.
Oh, they do not.
And a foreclosure doesn't just take the house. It devastates a person's credit score for up to 7 years. It wipes out whatever equity they had built up and makes renting a new place incredibly difficult.
Right.
So executing a rapid sale lets the homeowner pay off the lender before the bank seizes the asset. They save their financial reputation and usually walk away with some residual cash to find new housing. It is like they aren't looking for a real estate agent. They are looking for a financial trauma surgeon.
A financial trauma surgeon. That is exactly it.
You need a fast, clean intervention to stop the bleeding, not a 6-month wellness plan.
If we connect this to the bigger picture, what we are really talking about across all these scenarios is the premium placed on liquidity.
Right.
In moments of acute financial pressure or profound emotional transition, liquidity is king.
Yeah.
The utility of having cash in your bank account by next Friday far outweighs the speculative theoretical value of a house that might sell for a little more money 4 months from now. And the final category, liquidating rental investments, really illustrates this perfectly.
The accidental landlords.
Yes.
People who maybe couldn't sell a house a few years ago, so they decided to rent it out. And now they are suffering from deep property management fatigue.
Exactly.
You are dealing with uncooperative tenants, late rent checks, constant calls at 2 in the morning because the water heater broke. And here's the kicker. If you have difficult tenants in the house, selling that property on the open market is nearly impossible.
Almost zero chance.
Nobody wants to buy a house. They can't tour easily. And standard buyers certainly do not want to inherit a hostile tenant.
No.
But the direct buyers just absorb all of those complications. They buy the house with the tenant still in it.
They take on the burden of the eviction process if necessary, the structural overhauls, the code violations.
Yeah.
But, we really have to run the actual numbers here because this is where the perception of losing your shirt usually happens.
Okay, let's do it.
Because prioritizing speed and offloading headaches sounds great in theory, but does it inherently mean taking a massive financial loss?
Right.
The framework argues that the math is much, much closer than people realize when you look at the gross offer versus true net profit.
This is the crux of the whole thing. There is this incredibly common misconception that a 7-day cash sale means you are sacrificing 50% of your equity. Let's actually walk through the hypothetical example they provide because it is really illuminating.
Okay.
Let's use a baseline. Imagine a property in Riverside that could theoretically sell for $500,000 on the open market, assuming it in great condition.
Okay.
But it's not. It requires $20,000 in foundational and cosmetic repairs just to be competitive. So right off the bat, you have to spend $20,000 out of pocket. You are at minus $20,000.
Right. Then you have the timeline drain.
Okay?
It takes a month to renovate the place, assuming you can even get contractors scheduled.
Big assumption.
Exactly. Then you list it. You deal with showings, find a buyer, and go through the standard 45-day closing period. Conservatively, that is a 4-month process. And during those 4 months, time is literally money. The owner is still paying the monthly mortgage. They are paying the property taxes, the insurance, and the utilities to keep the lights on and the air conditioning running for open houses.
Okay, let's do the mental math on that. Let's say the mortgage, taxes, and insurance come to $2,500 a month. Over 4 months, that is $10,000 in carrying costs. Just burned, evaporated.
Then finally, you close the sale at your $500,000 asking price. But you aren't done paying.
Nope.
The real estate agent takes their standard 6% commission off the top of the sale price.
And 6% of $500,000 is $30,000. Gone.
Gone. Then you have escrow fees. And in many traditional sales, especially with older homes, you have buyer concessions.
Oh, right.
The buyer's inspector finds an old HVAC unit, and the buyer says, I want $5,000 back in closing costs to deal with this later.
So what does this all mean? Let's add that up. You have $20,000 in repairs, $10,000 in carrying costs, $30,000 in agent commissions, and let's say $5,000 in concessions and escrow. That is $65,000 in expenses just to sell a $500,000 house.
Yep.
So you walk away with $435,000, and you had to endure 4 months of stress managing contractors and keeping the house pristine.
Right.
If the direct cash buyer comes in on day one and offers you $425,000 as is cash in 7 days, the difference is only $10,000.
Exactly. And that is the shift in critical thinking this framework is advocating for.
Okay.
Homeowners are conditioned to stare at the gross potential value. You know, that speculative high number on websites like Zillow?
Yeah, everybody looks at that.
Right. Instead of calculating the net actualized value, the gross offer from the cash buyer is absolutely lower than the speculative retail listing price. But the actual net capital deposited into the seller's bank account is highly competitive because it completely bypasses the invisible fees of the traditional system.
The sticker price is a mirage, and the cash funds are guaranteed. You don't have to worry about a buyer backing out on day 40 because the bank suddenly decided not to approve their loan.
Exactly.
In a city like Riverside, where the market can fluctuate based on broader economic policies or interest rate hikes, waiting out a 4-month traditional transaction actually carries measurable risk.
It is a highly calculated financial maneuver.
Yeah.
Look, this model isn't for everyone. If you have a pristine house, endless free time to manage showings, and no immediate need for capital, the traditional market serves you perfectly well. You will squeeze that extra $10,000 or $15,000 out of the sale.
Right.
But for those navigating complex life transitions, managing burdensome inherited assets, or facing acute financial pressure, the 7-day cash sale is a highly functional tool. It is an exercise in calculating the true cost of your own time and your own peace of mind.
It really is.
Yeah.
We started this deep dive talking about how real estate used to feel like a predictable recipe. But looking closely at this demographic in Riverside, it is clear that for a lot of people, the traditional system is just too slow, too expensive, and too fraught with friction.
Mm-hmm.
The 7-day sale is providing a totally different exit strategy. But I want to leave you with a thought to mull over, building on everything we have just discussed about removing all this friction. If private capital continues to step into the housing market like this, removing the traditional hurdles, the agents, the inspections, the long waits, and making it as easy as a 7-day cash wire, how will that change our emotional connection to homeownership in the future? If selling a house becomes as fast, fluid, and impersonally calculated as selling a stock in a portfolio, does a house remain a home? Or does it eventually just become another highly liquid asset on a balance sheet? Something to think about.